if you have a skill set that you could use in an industry, and it can be any industry, right, that you want to get into, use it and leverage it, because you could be valuable to someone else who may be missing that skill set in their business. And that's the way you can continue to learn before, you get to a point where you can go off and start your own business by yourself.
Welcome back, everyone, to Keeping It Real Estate. I'm your co-host, Mike Roeder, and today we have a special guest, Reed Goossens, a two-time best-selling author who is also the co-founder of Wildhorn Capital and the founder of the podcast Investing in the U.S. Reed dropped everything and moved across the world to America from Australia a while back to follow his dream of financial freedom. And with that said, it's a pleasure to have you on the show, Reed.
Thanks, Mike. And I'll just those bios are always a little bit old. Wildhorn is my former company, a new company, RSM Property Group. But it's been a hell of a ride since it's coming here, and I'm sure we're going to get into it. And really looking forward to sharing some cool tips with your audience.
Definitely. Well, if you want to start off by giving us a little bit of your background, what were you doing before you came over to the U.S.? What prompted you to move over here, and what got you started in the real estate investing arena?
Yeah, so my background's in structural engineering. If you're watching the YouTube video, there's a picture in I guess that must be the left-hand corner if you're looking at the screen, of a concrete building that it was one of my first buildings I was as a structural engineer working on in New York City when I first moved to the US. That was back in 2012. But the bug for real estate started before then, in my mid-20s, in probably 2008, 2009. I really started to want to do more with my life, and being a civil structural engineer just wasn't really doing it for me. And that's where I stumbled across Rich Dad Poor Dad. That then stumbled across, investing, real estate investing, because I happened to be a structural engineer building stuff. And then I met a girl, and that girl happened to be American. And I wanted to, I also wanted to live in New York City for a period of time. I think there was a real lure for expats. And it was just sort of moving to the US, rolling the dice and saying, look, there's a visa here for Aussies if you can get a good working job. And I didn't have a job when I rocked up, but I was chasing this girl, wanted to live in New York City. And it was really just a plan of coming here for a couple of years, see how it works out, and move home, sort of just tick that box. Here we are over 10 years later. You mentioned I bought my first property for $38,000, and that was in upstate New York when I was living in New York City in 2012. And today, through two companies that I've founded, Wildhorn and RSN, there's a collective size of over $800 million in multifamily acquisitions, and written 2 books, got a podcast myself. And I'm not saying to boast, I'm just sort of saying it to, if I can do it, so can the average bear, average American bear, that is. Because I also had visa issues, right? I couldn't be in this country without marrying my wife or without having the E3 visa that Aussies get. So a lot of things, a lot of barriers, but it didn't stop me from going off and trying to achieve what I wanted to achieve.
And do you think moving over to the US, so it sounds like you moved here more so because of the relationship that you were in and you thought it'd be, a cool place to live, but do you think it was beneficial moving over here and starting to invest in real estate, or do you think you would have gotten the same success and results over in that?
Yeah, it's interesting people say that, and I think the answer is yes, but no, which in the sense of like when you come halfway across the world, like if maybe I rocked up in London or Asia or Europe, there's still that like sense of I'm coming here with no real plan and let's see how it works out. The plan was definitely not to invest in real estate when I moved here. It was like I had the bug. It was coming here to live. And then it was like, well, let's keep scratching that itch. And then all of a sudden you're like, wow, there's an incredible opportunity here. Okay, wow. Like it just kept progressing. And, as since 2012, the multifamily has had the biggest run ever, right? We're all sitting here a lot more wealthy for that and very grateful for the opportunities. But back to your question, if I was dropped in another country to do it all over again, I think the act of coming without really a plan can sort of scare the crap out of a lot of people, but it also puts your back against the wall to say, well, the only way is up, if that makes sense. So you're a little bit more resilient. You're a little bit more like hungry to make it work.
Definitely. That makes total sense. And, rewinding, you bought your first property in 2012. I mean, what a fantastic time to get into the industry. It obviously had bottomed out. It was starting to come out of the the trough, and you bought that first asset for 38K, so pretty low amount. Did you rent that property out? Can you walk us through the journey and some of the initial challenges that arose from buying that first property?
Mate, so many challenges, right? That was a 12 or 13 cap on paper. It was the most amount of units I could buy with my own cash. There was no lender because I fresh off the boat. I had no credit score. I didn't even know what a credit score was, in the States, So all these things were just like, but I knew because I'd been already bitten by the bug in Australia, and I was self-educating in Australia before moving to the US. I spent the first 6 months in the US really acclimatizing myself to the way Americans talk about cash on cash and IRR and cap rates, and just understanding the local lingo, and then that sort of figuring out, well, how do I go buy a deal, or how do I go get my first deal? And $38,000 for me, coming from Australia, like from most Western countries, were like, that's so cheap. Like I don't have $38,000 properties in Australia. I don't think you have $38,000 in Western Europe, or in England, or in Canada. It's very unique to the way the world was and still is to some extent here in the US, where you have these primary markets and then these secondary and tertiary markets. And it was just a great way to get my first deal done. And then the old saying is you don't get to deal number 10 without doing deal number 1. So, but in saying that, I had a drive-by shooting at this first property. I had tenants fighting with each other. And it was but it was my money, right? It was, if I was going to lose it and again, $38,000 is a lot of bloody money, but it was not like I still had a good job and all that stuff. Like, it wasn't like I was, betting the house on it. But it got me off the mark. And I think that's the most important thing. That got me to my second deal, which I bought again through a bit of a refi from that first deal, a duplex in Syracuse, New York. And then I got into a fix and flip, and then I started build the podcast and all that sort of stuff, and the brand and the books, and then I started raising money for other people. Like, the opportunities started coming my way by putting one foot in front of the other. But I didn't have like a 5-year goal to be like, I need to have a podcast and a book and all that stuff. It was just like stumbling along the way. Effectively, I'm not, don't get me wrong, I had mentors and stuff all throughout that, but that first deal was the starting point of what you can achieve, 10, 12, 13 years later.
Yeah. And it's amazing how it builds on itself. I fell into real estate kind of the same way. We had house hacked our first house, turned that into a rental, and it slowly evolved over time and slowly snowballed. And I love how you said you don't get to deal 10 without doing deal number 1. And I think that's, there's a lot of investors out there that are considering investing, whether it be passive or active, and just get your foot in the door, get started, and you never know where it's going to take you. So, you bought that first property back in 2012. Now you've acquired over $800 million worth of commercial real estate. I'd love to hear some of your biggest takeaways that you've got over this journey, over the last 10, 12 years that you've been investing in real estate.
So one of the stories that I tell a lot in this journey is I wanted to be in real estate 24/7. And so when I moved to Los Angeles in 2014, I'd started the podcast, and I started, and it was, no one was listening to it, but I was trying to raise money for other people's deals, my mentor at the time. But then I realized, well, hang on, I've got this skill of being an engineer. Like, and I hate, I'm so sick of engineering, but I had this skill set that I was like, well, maybe this skill set might translate. And that's how I couldn't be in this country without either marrying my wife or the girlfriend at the time, or continue to have another corporate job. So I think Mark Cuban talks about going out and finding the best paying corporate job in the space you want to be in to continue learning. So there was like this sort of, on my off time, I had the mentor and trying to underwrite deals across the country and do multifamily. But in my day job, I was building ground up construction, multifamily in Long Beach for a big developer. And that was such a great experience because I was able to see how the big boys do it. And that gave me credibility in my own deals to be like, hey, I actually work for a developer, right? I'm doing this day in, day out. Now, I don't go and develop assets today. We go and buy existing multi, but I come from that world. So I sort of encourage people who are listening to this story, like, if you have a skill set that you could use in an industry, and it can be any industry, right, that you want to get into, use it and leverage it, because you could be valuable to someone else who may be missing that skill set in their business. And that's a way you can continue to learn before, you get to a point where you can go off and start your own business by yourself.
I absolutely love that. I mean, find a job in the niche or in the industry, continue to learn. And I love that you mentioned that it gives you credibility as well. I hadn't even thought of that. But if you're working in the industry, you're building that experience, you're building that knowledge, of course, it's going to give you credibility. So that's amazing. Now, is multifamily the only asset in your portfolio, Reed, or do you have other commercial assets in your portfolio?
No. At this stage, no, just multi. But we are looking to expand the on the board over here, the 10-year, 5-10-year goals where we want to be. We're entrepreneurial first and foremost, but we know the lane where we've been really good at. And we think there's a lot of great opportunities coming around the corner, and we can obviously talk a little bit more about what is coming around the corner. But there has been a niche that we've carved out, and we we think we're pretty good at it. We're not the only sponsor in the space, but we've, given my background, it was just been a natural fit, the multi space, because it came from the ground up of building multi and designing multi. So something like retail or hospitality, I've never had the experience in that. So I haven't delved into that there, so to speak.
Got it. And before we jump into some of the opportunities that you think are on the horizon, I'd love to hear your current portfolio. What are some of the common characteristics of your high performing assets? Is there any commonalities at all?
Fixed rate debt. I say that tongue in cheek, but we've had obviously a serious run up in interest rates, which has caused pain across a lot of the industry, commercial in general, office in particular. But the ideal deal we would look for today is 80s or newer. Average household income has been really important within a mile of that. That needs to be above $60,000 to sort of get away from the lower end of the spectrum. And you're seeing growth in a market, and you're trying to buy stuff with positive leverage, which means you're going in cap rates higher than your interest rate. So that's kind of the box we're looking at, and check size between $1,000 and $1,500 for studios on one end and 2 bedrooms on the other. So that's across. We're in Phoenix, Central Texas, and the Carolinas.
Got it. I appreciate you sharing that. And back to what we were talking about earlier, it sounded like you think there's some great opportunities coming around the corner. I'd love to hear if you're thinking that's in the multifamily space or other commercial assets. What are you seeing, and what do you think's coming?
Yeah, it's good. I don't have grey hair. No one's got a crystal ball, right? But I talk to a lot of talking heads. I listen to a lot of talking heads. I try and consume as much knowledge as I possibly can to be more educated from my own portfolio. And I think the big thing is that we've seen, you've got to understand where we come from. So we have had historically, coming out of 2008, we've had probably very low rent, if that makes sense, when you look at what you're buying, and the cap rates in the multifamily space were quite attractive. And then you've had the Jobs Act that's come in 2012, and a lot of investors, including myself, probably including you, Mike, as well, we've got our start by raising capital from the crowd. And so have a lot of other people, and which means there's been a lot of people jumping in the pool in the commercial industry, where historically that was the good old boys club at the country club, where you could only get involved in a commercial deal if you knew that knew the owner. Today, where there's a lot more disruption in investors can invest directly with sponsors, which I think is a good thing, right? But if you don't know where the history's come from, you got to lay it out. So now there's all these people in the industry. Cap rates have compressed. It's competition for deals. Money's cheap as well. Let's add on top of that before COVID, money was really, really cheap, and there was just a lot of people out there doing deals. Today, we've had a sort of swing back the other way, where it's like, okay, there's a lot of people in the industry trying to buy deals. There's a lot more people looking to rent. Rents have gone up dramatically over the last 3 or 4 years, probably even since 2012, right? You also then have the high inflation, right? And then the Fed's increasing interest rates to combat that. Whether you agree or disagree, it's happened. And now we're in this space of like, no deals are getting done. Not like the industry is completely dried up because people have bought at 4 caps, and now market cap rates are 5 or 6%, right? Trending back towards where we were in 2012, 13, 14. And so owners of deals don't want to sell, because if you're selling at a higher cap rate, you're probably losing value in your asset, and that can eat away some of your equity. But then there's all these maturities coming. All these people have bought deals in the last 3-4 years, and their loans are coming to the end of their maturity date, and they've got to refinance or redo a loan in now a higher interest rate environment, which I bet none of them have underwritten to 500 basis point expansion on the Fed fund rates over a period of the last 2 years. Like, no one underwrote that, right? So there's this back to opportunity. People are holding out to say, I want the market to correct. But then you've got the market saying, well, hang on, Have we really got inflation under control? Are we going into a recession? And then you've got people on the renter side where it's just saying, I can't keep doubling my rent because I'm only earning $50,000 a year and the payroll isn't keeping up with that. So there's just a lot of things sort of in the pot, in the soup right now that are sort of indicating that there's going to be a massive buying opportunity. It's just about like, when will it snap? And we've got an election next year, right? So there's all these things that are sort of saying that, like, I feel personally in some of my portfolio that we've already been in a recession for about 6 months. We as housing providers, we see when delinquency goes, we see when rent prices come off. And the Fed doesn't see that for probably 6 months in arrears. So they're making decisions on old data. And if you look back 6 months ago, well, some of the data was still looking pretty rosy, right? Now, I'm not saying the Fed does all their analysis just on housing, but housing providers like us, I truly believe we're at the coalface and we're the sort of that canary in the coal mine where it seems like, and coupled on the fact that we're seeing a distress in the commercial industry because of this rise up in interest rates coming from a historically low interest rate environment. So I said a lot of things there. I'm going to pause, but there's a lot of things on my mind right now, thinking and looking into 2024 to see one, it's a great buying opportunity, but two, it's like, how does your existing portfolio manage this continued high interest rate environment?
Mm-hmm. Yeah, and I think that's something to consider. Is inflation under control? I don't think anyone truly knows. Yeah, CPI is coming in a little bit lower than expected, but that's just 1 month or a few months. I mean, who's to say that it doesn't go back up in the near future? So that's a position that we've taken is, hey, we don't know. Let's mitigate the risk and let's put in the debt that we feel comfortable with, that we're going to win regardless of the situation or the outcome moving forward. I'd like to hear too, what are your true thoughts? So it sounds like you think that inflation may continue to uptick potentially in the future. Interest rates may, if your gut feel, what do you think is going to happen over the next 2 years with interest rates and inflation?
Gut feeling is, and again, I'm not an economist, but look at the history of what has happened. The pace at which we increased interest rates, not we, or the government increased interest rates to curb inflation was extremely fast. It begs to be like, something's got to break. We had SVB, and if you look back at Lehman Brothers in 08, or it was 07, they failed. It was 18 months later that 08 hit. We're not 18 months in. Now, I'm not saying it's going to be verbatim. Every recession is slightly different, but I believe we're going to go into recession because of restrictive territories that we're already in today. And if you want to talk about restrictive lending territories, you take the Fed rate minus CPI and get the real rate, and it's positive. When it's positive, it's restrictive. When it's negative, it's accommodative. But then I go back to my tenants and be like, I've seen delinquencies really uptick this year since summer. I've seen it's very hard to attract a lot of new supplies come online across a lot of markets, right? And we're now trying to compete with concessions. But then you've got builders who can't afford to keep their buildings, to deliver units in 2024, 2025 because interest rates are too high. So I think something's got to give. I just don't know what it is just yet. And then you've got the black swan events, right? We've had Ukraine, we've had COVID, we've now got the conflict in Israel. These things will impact the economies, and part of me wants it to break because this whole drawn out, particularly multi-space, it's been like, let's just break the bloody thing if we're going to break it, and let's have a reset so we can start getting back to actually doing deals. Because right now, I think over time, and you would know this, is the last 12 months, we've seen like an 80% reduction in deal volume, right? It's very hard to get deals to pencil today. There's not a lot of lenders out there. Lender leverage is really, really low because of DCR constraints. So it's kind of like, and we've been in this environment for at least 12 months. It's like, I want to get back to doing more deals. And so I just don't know what that thing is going to be that causes, is it staying high for longer? But if you look at the data, it's like, well, that's going to break something in itself. And something might already be broken that we're not aware of when you look at an SVB example type. So an optimist would love to see that we have cuts starting in 2024. We've already had 2 pauses, I think, back to back now. So that I think it's signaling the beginning of the end. But then you've got an election. So that's going to play into it as well. So there's a lot of things coming down the pike and then there's stuff that you don't know really what's going on, like loans that could be called due in the office space, or the multi space because of higher interest rates, people being foreclosed on. I'm hearing stuff happening, but is that contagion? Is that going to be widespread, or is it more isolated events? Again, back to my optimistic side of me, I think there's not going to be as much contagion and you'll have more lenders working things out with office owners or multifamily owners who are in distress because they don't want to take back. And when you start taking back, you're either going to be forced to because you're the lender, or you don't want to do it too soon because then wildfire spreads and everyone panics and it just becomes even worse. So it's just kind of like a waiting game, and it feels weird, and in my gut I'm like, I can't still see the forest from the trees at this point. So I don't know if that answers your question.
No, it definitely does. And I think there's a lot of things on the horizon that could break, like you're saying. I mean, there's auto loans, a lot of variable debt out there, student debt, like you said, the war's going on. There's small businesses with variable debt. There's a lot of regional banks that are really suffering. So where are the cracks going to start to show, and when is that going to happen? But it seems like it's becoming more and more clear, and it's coming down the pipeline. So appreciate you sharing that. And you had mentioned the election too. I mean, what are your thoughts on the election? Do you think, the other day I was actually talking to one of our big investors, and he was mentioning, he's like, hey, I have multiple very knowledgeable investors that are saying that could affect how the Federal Reserve cuts rates, because they might not want to cut rates, because it might be seen as interfering with the election. And so I thought that was really interesting. Yeah. What are your thoughts there?
I'll give a shout out to the Rate Guy podcast, JP Conklin from Pensford. He's the guy that I actually heard probably the same thing. What he was saying in that, and I tend to agree, is the Fed doesn't want to get too close to the election, then start cutting rates, because then they could be accused of doing that. The one thing that JP was talking about was that positive real rate. And are they trying to, because the positive real rate does put brakes on the economy, and we're starting to see it. As CPI reduces, your positive real rate of interest rates increases, and that is more of a pressure on the brakes. One, they could do nothing as CPI falls, but that real rate increases and becomes even more restrictive and things even more break, or they try and cut, but lead it on a little bit of autopilot and maintain like a, whatever it is, if CPI is, I'm just doing round math, 3% today, and the Fed is 5%, the real rate's 2%. And I'm not, that's not the exact numbers, but the example is, if they want to keep a real rate of 2% and CPI starts to go down, do they cut in lockstep with that to maintain that positive number as CPI comes down? Don't know, right? And that's your investors are probably right that there's the election will have an impact. It just, what is that impact going to be? Is it going to be do nothing until after the election? But I think you then run the risk of really screwing the freaking economy, or you start earlier, and I'm talking like Q1, Q2 next year, and then you start easing it, and you're still far enough out from the election to say, well, I'm not being impacted by the election, I'm more being impacted by data. So I feel like it's going to be the latter, that they do start cutting, because it just feels so, with all those other black swans that are happening right now, something doesn't feel right. I can't quite put my finger on it, but there's too many rose-tinted glasses out there to see like, oh, everything's great, everything's hunky-dory. It's like, is it? Because I'm not feeling it. I know other businesses aren't feeling it. I know the average renter's not feeling it. Like, something's going on. The people's savings are down. Like, there's something going to crack, auto loans that you're talking about, like it has to break, like it just has to break. So maybe Christmas is, everyone wakes up in 2024 and they're like, oh yeah, let's wake up to reality, and we're all in it together now, and then it breaks. The other thing is the lending window, which JP talks about as well. Back when SVB went into where it went into, there were, the Fed opens up a lending window that for distressed banks, and they don't release those names for 2 years in, so you don't cause panic. But that lending window is supposed to close, I believe, in March next year, because SVB happened in March of this year. If that continues to stay open, and again, then there's more systematic problems that we aren't being told about. And that's the concern that I think we're still too close to the fire to really understand. And back to the Lehman Brothers example, it was like they failed, and then the recession really didn't come until 12 to 18 months later. So it's going to be interesting. There was another interesting thing I'm looking at is tracking cap rates of multifamily and the 10-year. And the data that I'm presenting a state of the market for my investors coming up. And one of the graphs I saw was, obviously it's come down in 2022, 2021, 22, and then it started to spike. But what is interesting is that the 10-year and the cap rates have never crossed. And I think right now they've crossed, because cap rates, or the 10-year, is above where some cap rates are projected to be, again, across the nation. And I don't know if that's ever happened in history when you look back, and it's again, it's one piece of data. It doesn't mean that and goes back to my point earlier that I think there's more pain coming. I think there's more expansion of cap rates to be had if they stay higher for longer, because if you look at history, the 10-year and the cap rates, the average cap rates for multi have never crossed ever where the cap rate is less than the 10-year. So if they stay higher for longer, I think cap rates are going to expand even more, meaning a better buying opportunity. But then it has all those other ramifications about positive rates and other things that just puts pressures on an economy that you kind of just want to break it and be like, all right, let's get on with it and start to rebuild.
Definitely. Well, some great information there. I appreciate you sharing your opinion and what you think's coming down the pipeline. I'd love to shift gears a little bit here. So, Reed, you've written 2 books, Investing in the U.S., The Ultimate Guide to U.S. Real Estate, and then 10,000 Miles to the American Dream, Our Story of Financial Freedom. I'd love to hear a little bit more about those books and what inspired you to write them as well.
So the first book, if you're watching on YouTube, it's behind me on my shelf. Investing in the US was my podcast that I started back in 2014. It's called Investing in the US, coincidentally. And it was really just taking the first 20 episodes that I did there was really each episode was about a learning point in my investing career. So understanding US investing lingo, understanding how to get set up legally, LLCs, EIN numbers, understanding the team you need to build around you, how to analyze the market. Very 101, and that was that book, and that was launched, I think, back in 2016 or 17. And it's just a great, just taking the podcast, repurposing it into written form and putting it into a book. So that was the first one. The second one was guys that I'd interviewed on my podcast, Aussie guys who'd moved 10,000 miles, coincidentally, across the globe, and they've started real estate companies here in the US, and we all wrote a chapter, and each chapter is slightly different. So we've got a guy in there talking about real estate tech companies that he had started. We've got a guy talking about mobile home parks, and other guys talking about fixing and flipping homes, on the sort of first entry homes in, say, middle America. I was talking about raising money. There's obviously multifamily in there. So it's just a collection of stories of other guys who've done the sort of similar path, even though it's very rare, and built real estate companies, successful real estate companies here in the US, but happen to be from Australia.
Got it. Fantastic. Well, I appreciate you sharing that. Looking forward to checking those both out. And, I'd like to ask too, Reed, you got a lot going on. You're managing a big portfolio. I'm sure you have a team behind you. There's a lot of demands in the real estate industry right now. What do you do to manage your work-life balance?
Yeah, it can be tough. We just had a baby as well, which you've got kids. It seems like Groundhog Day now that you have a kid, and I think of my life before a child. Meditation's a big one. I have to meditate. Prioritizing sleep is another big one. I need it. I'm in my mid to late 30s now, and exercise are big ones. Trying to cut down on not eating well. Trying to cut out bad things like alcohol and all that sort of stuff, or not as much of it. So just trying to make sure that you're centered and your feet are firmly on the ground, and that being in the position that we are in, there's going to be stressful times, and understanding how to manage that stress, and through a couple of key things like the sleep, like the meditation. I also have a coach who helps me. She's actually coming here in a couple of hours. So it just helps me with the top 2 inches in the brain to make sure I'm not getting too overwhelmed. But it happens all the time, right? It's as we got on this podcast, we talked about putting out fires. Sometimes if you feel like a firefighter all the time, just putting out fires that crop up, that will always crop up in small businesses. So yeah.
They certainly will, whether you're in multifamily or any other type of business. I mean, there's always something going on, always some sort of issue to resolve. And I appreciate you sharing that. I mean, I love meditating. I think that's very, very beneficial. Prioritizing sleep. I was always a guy that thought, if I got 6 to 7 hours of sleep a night, I was perfectly fine. And we hired a life longevity coach recently and went through their training. And it was just mind blowing on how important sleep is. Yeah. And how, I actually need to be in bed around 9 hours to get my peak performance sleep. Which was just wild to see. And then you said exercising, eating well, a coach. I love all of that, Reed. Before we part today, any advice for investors out there considering investing in multifamily yet in 2023 and then moving into 2024? Any tips?
Oh, look, I think the fundamentals are still there, right? Affordability is still a major issue across the United States. It's a great investment from the long term. I do think investors have to change their mindset about, like, we've had a very good 5, 6, 7 years where people have doubled their money in 3 years. Real estate historically has been a medium to long-term investment. Treat it like that. It's not a fix and flip type of game. And we're going more back to those fundamentals. And it's a good, in a diversified portfolio, having a slither of real estate, specifically commercial, for a 5 to 7, 10-year hold is fantastic. You're going to get fantastic returns on your money. It's great for you, obviously for tax benefits. But just remember, it's not like if you've seen the gurus saying that they've doubled people's money in 30 months. It's true, but like, I don't know if it's going to continue to happen like that. The last 5 years is going to be different for the next 5 years. So just keep that in mind. Understand it's a medium to long-term game, and you should be just fine.
Well, Reed, thanks so much for coming on the show. I truly appreciate it. If any of our listeners want to get a hold of you, how would they go about doing that?
Easiest way to go to my website is reedgoossens.com. That's ReedGoossens.com. If you're ever coming through Los Angeles and you want to hit me up, we go for a coffee, go for a beer, go for some lunch, talk shop. It's info@reedgoossens.com.
Thanks so much, Reed. Appreciate you coming on.
Thanks, mate.